Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Ink Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 18 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Thanks for having me back, Jim.
Ted, the bond market and U.S. interest rates, what are we looking at and what could we be facing?
The bond market is really going to be driving, I think, the medium-term trends, at least in the U.S. stock market and likely the Canadian market as well, in that, of course, eventually stocks are expected to pay a dividend, and you have to discount those dividends into the future based off of interest rates and long-term interest rates. And we've seen some very interesting moves in the U.S. market in terms of insider sentiment. And we put out a blog piece on CanadianInsider.com before the Fed meeting called "The Elephant Driving U.S. Bond Yields." And we suggested there's more than one elephant in the room that could upset the market, or maybe make the market go up. We'll have to see. But the two elephants that we see, the first elephant is the Fed. Now it has this issue of this bloated balance sheet that it was trying to essentially dwindle down, and the market started anticipating that the Fed was going to stop doing that. And interestingly enough, we had the Federal Reserve Chairman, Jerome Powell, on Wednesday hint that they might stop reducing their balance sheet. Now, this is important because if the Fed stops reducing their balance sheet, everything else being equal, interest rates, long-term interest rates, could sort of have a ceiling, in that if the Fed is no longer liquidating its bond portfolio, it should support bond prices. Now, that's good news for utility stock insiders because utilities tend to benefit from low rates. Bad news for insurance company insiders, because insurance companies would like to see a steepening yield curve, and that usually means higher rates. But we're seeing just the opposite in terms of insider sentiment. The insurance company executives are quite bullish, and the utility, this is in U.S., utility insiders are quite bearish. So even though we've had this Fed backpedaling and the bond markets come off, and the yields have come off today, I think in response to some very poor job claims numbers, on balance, it looks like insiders are pretty well positioned for rising long-term bond yields. So, Jim, if it's not going to be the Fed that drives up bond yields, what's the other elephant we're looking at? Well, that elephant is the U.S. federal debt. Now, actually, I was listening to the John Kaiser interview you did yesterday. He talked about the U.S. federal debt, and that is, we were talking about as well in our blog piece. That the Congressional Budget Office just came out earlier this week, and they said deficits remain large by historical standards, and the federal debt grows to equal 93% of GDP by 2029. So this U.S. debt problem is going to get more and more attention as we move through the next few months and next few years. That is likely to be a risk to bond yields on the upside. So on balance, the two elephants charging around in the room, looks like the debt elephant is the one that could do the most damage.
Is there any sign the U.S. government has any plans to pay down that debt?
I mean, we'll be lucky if they can fund it. We've got another debt ceiling coming up in this late winter here, and there's a risk that we'll get gridlock in Washington, and we'll be back to what we had in 2011, where there was a risk that there would be some Treasury bill coupon payments missed. So I don't think it'll come to that, but there's always a risk that it will come to that. So it will be interesting to see how financial markets behave going into that circus, which is likely coming to a cable news network near you very soon.
Well, we have a president who won't hesitate to shut down the government to try to get his way.
Right. Now, whether he is willing to miss a bond payment or two, that'll be interesting. I don't think he's been in his real estate career. I don't think he minded missing a bond payment or two. So we'll have to see if that same attitude carries over to the government. It will have major implications to capital markets if it does. Again, I don't think that's a base case. But in the meantime, what have you got? You're going to have some people worrying about the risk associated with that. And even if they do sort of get through this debt ceiling situation, the projection for the U.S. debt is up and up and up. And at some point, you're going to be factoring in higher and higher risk to that debt. And as it stands right now, the U.S. has the highest long-term bond yields amongst the developed world. Now, some will say, well, that's because their growth is fairly strong, but that growth is really not seen as being very sustainable because it was all debt fueled, front end loaded by the Trump tax cuts, which are now starting to play out, but they will have a petering effect, and particularly if some of the sunset provisions in those tax cuts come into effect in a couple of years. So we're in a very interesting time for the U.S. bond market, and it's going to impact every asset going forward is going to be affected by that. And one other consideration that Canadian investors should keep in mind, and we talk about this in the blog, is that there's this perpetual doom and gloom about the Canadian dollar, and some of the gloom is well placed. I mean, we've got a federal government that's doing everything it can to dampen growth. It came in with a mandate to boost growth, and it actually started on the right track, but then they set the seeds quite early in their mandate for the problems now, and that is the payroll tax hike that's come in this year, and of course their incompetence with the pipeline. So we've got the Ottawa strangling growth in the oil patch, and we've also got Ottawa strangling growth when it comes to payroll creation. So rather bizarre formula for a political party to implement in an election year, but that's what we have, and that's why Canadian growth is going to be kind of ho-hum this year. However, that doesn't necessarily mean the Canadian dollar is going to get nailed, because you've got to put into context the Canadian federal debt situation compared to the Americans. And you know what? As much as we keep hearing about how bad it is in Canada with the federal debt going up and or still being in the red, it actually appears to be coming down a bit. But well, at least the last numbers I checked, and I stand to be corrected on that if that's not the case. But the fact of the matter is we pale in comparison to what's going on in the United States. So far, the U.S. has been able to get away with it because of their reserve currency status. But more and more people, I think, are going to start to get worried about whether the U.S. is abusing that status or not, and whether there's a default risk or more likely kind of a monetization or inflation risk to deal with that their overhang of the debt.
We'll have more with Ted Dixon right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ted Dixon. Ted, we've seen some pretty strong spike ups after the Christmas time lows on the stock markets. Is the Dow in position to perhaps feel that's been a major correction and it's going to go up again?
Well, the Dow's been rallying for sure. Also, other broad indices across the world. What we've been focusing on, really with the kind of razor-sharp focus, is how the Canadian Insider Index is behaving versus the major blue chip, big company index in Canada, the TSX 60. We've been doing that because the Canadian Insider Index is a growth-oriented index, and I mean growth. I mean sensitive to growth. I don't mean growth stocks. I mean looking at sort of mid and small cap companies primarily, not totally in the index, but it's weighted that way. And they're very sensitive to the outlook for global growth. And it has been outperforming the S&P TSX 60 now on a monthly basis for a few weeks. And that's a very positive sign because it suggests that investors are now having more confidence that the stimulation moves that are being done by China are going to kick in, that the Fed putting the brakes on interest rate hikes is going to kick in, so that maybe we're going to see a pickup in global growth. Now, I would say we're kind of 60 to 70% there, that it looks like that's what might happen, but there's still a very significant chance that this is kind of a false signal that we're getting. Canadian insiders are very upbeat about the situation. They were snapping up shares in the sell-off. So it's looking good, Jim. We're not quite there yet. We're monitoring it very closely. Every week we send out an update to our clients on what our signals are saying. So far so good. We'd like to see a little bit more confirmation, but if you find stocks in the Canadian market that have been beat up and are still trading at good valuations on pullbacks right now, if you're a value investor and you're prepared to deal with a potential another test to the downside, it may not be a bad time to start adding to your positions. That being said, there's a good case to be made for keeping dry powder here in case there's another major test to the downside. Should we get a government shutdown situation, debt ceiling crisis in the U.S., U.S. trade talks go off the rails, you can easily see global stocks take another path in the coming weeks.
We'll have more with Ted Dixon right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, what's the outlook for marijuana stocks in Canada?
Well, interestingly, marijuana stocks are also kind of pointing upwards in terms of insider sentiment. We've seen a big spike in insider buying in the last pullback, which is a fairly bullish sign. And now, we've moved through that what we call peak insider buying period, which tends to be the sweet spot for investors to start looking at names. Now, we would point to our, the blog that we put out on Monday that's available again on Canadian Insider. Will pharma stocks keep flying? In that blog, we point out that a lot of the names that we've seen are smaller names. So really select individual names that, for the most part, for the most part, have been globally or internationally focused. So looking at opportunities outside of Canada, Latin America, for example. We are seeing one or two smaller domestic plays. What tends not to be on the list are the very large names such as Canopy Growth, that have been really kind of bid up here, I think, by a lot of the institutions who missed out and kind of late to the game. Institutions, if they're going to buy a stock, they have to buy a big stock. I don't think that leaves a lot of room for smaller investors, or even small cap managers, or growth oriented managers to make a lot of money off of those stocks. I think some of the more interesting opportunities are in the smaller space, stocks under 500 million in market cap. There's some interesting stories that are coming up on our screens there.
Is this a case of investors really have to do their homework to make sure they're getting into the right place?
I think so. This is a really a change in the environment, I think, that we had from early last year, where speculation in the group is lifting all boats. You could buy the ETF, and you were doing quite well. The ETF has, of course, since corrected. So now, I think that, broadly speaking, sure that, I think the sector was overdone on the downside. You're going to see, perhaps some decent strength in the overall sector. But the real, I think, if you're going to play in this space, I think you have to really do your homework, company by company, management by management, opportunity by opportunity. And that's where our screens are not a bad starting point. We give a couple of the top ranked stocks in our blog that have made our screens, and take it from there. And again, doing due diligence in this industry is going to be super important. And there are going to be a lot of companies that don't make it, but of course, there's going to be some that do extraordinarily well.
What's your opinion of how the government has rolled out legal marijuana so far?
The government is doing what governments do. They, botch it up. I mean, BC has been slow, but BC looks like a model of execution compared to Ontario. At least Quebec basically said we're not going to be doing much of this, and they didn't raise anybody's expectations. So the rollout's like it's like the Trans Mountain Pipeline. What a disaster that's been. Anytime government gets involved with commercial activities, you always have to kind of expect that it's going to be botched up, and it's been botched up. And and I think that's one of the reasons why we're not seeing a lot of Canadian companies on our screens. And I think that some of the enthusiasm towards some of the bigger names on the TSX, is these institutions buying into the vision now. I mean, it's a little late, but better. Anyway, they're finally catching on. I hear one Bay Street large bank broker is now starting to cover marijuana stocks, so that's given the green light, I guess, for some of these institutions to rush in. But it's a little late, a little late for that. But some of the smaller companies, some of them are just getting started, and there's even even in the Canadian space, you can probably pick through which ones are well positioned to take advantage of this of the current situation domestically. But boy, it's a bit of a minefield. You're walking around through a lot of problems. Supply bottlenecks are not usually a great situation for wholesale producers. So you have to be very careful in terms of the domestic stories, and also, of course, the international ones, that you're not buying into hype, that you're buying into a management team that's really executing.
Do you think the Canadian governments just didn't do their research? They could have gone to Washington State or Oregon, where they seem to be pretty organized.
Oh, they probably did lots of research. It's just their inability to execute. They don't have the discipline of the marketplace to roll out strategies, but they have lots of budgets to go and do studies and go on field trips. So I'm sure there's been plenty of studies and field trips done.
Sure, and wood chippers bought. Ted, thank you so much for chatting with us.
Well, thanks for having me back.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, his website CanadianInsider.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Ted or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.